You probably know someone like this. He made a six-figure income for 20 years, lived in a great house, and took nice vacations. He was proof that climbing the corporate ladder was worth it. Then you run into him. He's 62, his consulting work dried up, and he's commuting to a contract role he clearly doesn't want. When we see someone in that position, we assume they hit a disaster, a terrible investment, a sudden market crash, a business failure. We look for the catastrophe, but the catastrophe rarely exists. The real threat to wealth during your peak earning years comes from a series of completely normal, socially acceptable purchases, things that felt like perfectly reasonable decisions at the time. This animated ledger shows the core conflict. On the left, we're measuring a purchase by its monthly cash flow, the affordable, bite-sized deduction, but on the right, we see the 20-year opportunity cost. The massive, compounded deficit created when that same money isn't invested. You do not have to make terrible financial choices to go broke. You only have to misunderstand the compounding cost of perfectly defensible ones. Let's look at the house upgrade. You have a growing family, so you buy a bigger place. The bank runs the numbers, checks your debt-to-income ratio, and happily approves the new, higher mortgage. It feels like the next logical step. The bank approves you based entirely on your immediate cash flow. They don't factor in your property taxes doubling or the higher insurance and utilities. Most importantly, the bank completely ignores what that extra monthly expense would do invested in the S&P 500 for a few decades instead. This chart illustrates the math on a typical housing upgrade. An extra $2,400 a month going into your house instead of an index fund earning a 7% return. Over 20 years, that exponential growth curve reaches $1.05 million. That is the actual cost of the extra square footage. Then there's the car payment. A 44-year-old pays off his SUV, but instead of keeping it, he trades it in early because the new lease deal is great. The salesman rolls the existing loan balance into the new one, keeping the monthly payment practically the same. He effectively signs up for a permanent car payment. Still looking at our chart, we add the car cycle. On the right, we map 21 years of continuous $740 car payments. If you drove a paid-off car and invested that same monthly amount, you would have nearly $400,000 in your retirement account. Being able to afford a monthly payment for a lifestyle upgrade is an entirely different math equation than affording its long-term opportunity cost. The math gets worse when we look at legacy purchases. A family buys a lake house or a cabin cruiser to serve as a gathering place for the kids and grandkids. It's a reward for years of hard work, but for most of the year, it sits quietly on a lake. This calendar grid maps the typical usage of a vacation home. Once you factor in the mortgage, taxes, flood insurance, and maintenance, you're paying carrying costs every single day. Out of 365 days, the house might be used for 28. That leaves 337 red days where the property sits empty, bringing the true cost to nearly $1,700 per night. These toys are depreciating liabilities that constantly drain cash. Buying a boat or a second home can easily consume $1 million in lost retirement potential, all to maintain the identity of being the person with the lake house. The generosity trap follows a similar pattern. Parents cover an adult child's loans, help with a city apartment rent, and fund a costly wedding. None of this is done out of stupidity. It's done out of love, one small request at a time. Funding your children's 20s at the expense of your own 70s is a mathematical trade. You drain your long-term resources today, which almost guarantees you will eventually become a financial burden on those same children later. The final piece is what we call the lifestyle creep stack. It's the country club dues, the premium gym memberships, the wine subscriptions, and the high-end credit cards. Each individual item is easy to defend. You have a high income, and a $200 monthly subscription is invisible to your daily bank balance. You say yes because you can afford it in isolation. This graphic shows what happens when those small line items accumulate. Over a decade, you quietly build a stack that bleeds tens of thousands of dollars a year. When you run those costs through our 20-year retirement timeline, that scrolling receipt totals up to a $1.65 million deficit. The brutal part about the stack is that the individual purchases are too small to form lasting memories. When retirement comes, you won't remember the premium streaming tiers or the wine club. You will only feel the absence of your wealth. This animated chart reveals the true danger. Nobody makes all 6 of these financial mistakes. If you did, you wouldn't reach retirement anyway. But as these curves merge together, you see making just 2 or 3 is enough to completely drain a comfortable retirement timeline. To protect yourself, Rule 1 is strict. Before you sign for any recurring expense over $500 a month, you run a 20-year calculation at a 7% return. You calculate the opportunity cost first. Rule 2 applies to luxury toys and vacation properties. Treat them as rentals. Calculate carrying costs, and if renting the exact experience costs less than owning, rent it. People always respond by saying, "I earned it," or "I can afford the payment." You certainly have the right to spend your money, but the ability to cover monthly invoices is disconnected from the mathematical reality of surviving a 30-year retirement. Living 30 years past retirement on a depleted account is a very long time to regret a boat. The math is entirely in your control, provided you recalculate those defensible choices while you still have the time to change them.